But what's not clear yet is how RLUSD translates to XRPL, translates to XRP, and then it seems like the engine that's funding a lot of this growth and acquisition is ultimately XRP, with the value expected of coming back from RLUSD. And so you have this like really interesting flywheel that is playing out for them, but not necessarily clear how the pieces are connecting from a fundamental practical standpoint. And so like respect to they're executing on the M&A path, and I could see paths here.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name is Simon Taylor. I'm your host for today, author at FinTech Brain Food, and head of market dev over at Tempo. Welcoming back from your many, many travels, the one and only, the man of the hour, the man with the power, Cuy Sheffield. How are you, my friend?
I am fantastic. We got Money 2020 this weekend. It's going to be a great time. Excited for the show today with some old friends coming up back on.
FinTech never sleeps. Stablecoins never sleep. We have the best possible guests. Diogo Monica, general partner at Haun Ventures, co-founder and exec chairman of Anchorage Digital, chairman of the NEA Foundation. Do you just like chairs? What's going on here, man?
I think it's a very fancy title. So when I get to select my own titles, I usually tend towards that.
But not a VC, a capital allocator. We will remember that.
Yeah, I'm an engineer that allocates capital, not a VC. That's exactly right. Thank you for remembering, Simon. Also, editorial note, stable coins, RWAs, and microphones. That is the third really like leg of the stool here.
Third leg of the stool. We're appreciating the microphone chat that was on before we hit record. But thankfully, somebody without overly verbose opinions of microphones is also joining us. Michelle O'Connor, founder of Digital Future, former VP of Market Expansion at TaxBit, and currently the sitting US Ambassador for the Global Blockchain Business Council. Genuine legend. Thank you for being on the show. How are you, Michelle?
Thank you for having me. I feel like I need a few more titles to share the stage.
We can, by the end of this podcast, we will have a few new ones for you.
Perfect.
Cuy is the only uni-titled guy here, actually. You're feeling kind of lonely. What's going on? It's a matter of time. All right, before we get into the content, I've got to remind everybody that views and opinions of contributors today are their own and might not reflect those of companies they represent. Please don't take anything we say as tax, legal, financial, or investment advice. Please do your own research. And of course, I've got to remind you that this podcast is sponsored by Centrifuge. Tokenized is also brought to you by our friends at Centrifuge. Through every crypto cycle, Centrifuge has been building, and today they are the market leader in tokenized real-world assets. Back in 2017, they were one of the first to mint a stablecoin backed by real-world assets with Maker. They're now launched an RWA lending capability with Aave, which is over $1 billion in total value locked. And Centrifuge works with major institutional partners to tokenize and distribute their funds. From treasuries to credit strategies, Centrifuge connects traditional finance to decentralized markets, creating new ways to access and put capital to work. Centrifuge is more than simply part of a tokenization wave. They've been kind of driving it in many, many ways. Whether you're an asset manager or a fintech exploring tokenization or a stablecoin allocator seeking high-quality institutional yield, look no further than Centrifuge. Cuy, over to you for the first story this week.
All right. From Fortune Crypto, Stripe-backed blockchain Tempo raises $500 million. So first off, Simon, congrats to you and the team. Pretty big round. This was reportedly led by Green Oaks and Thrive Capital. It also came at the same time as Dankrad Feist, one of the leading Ethereum researchers, a legend, announced that he was joining Tempo. So first, Simon, anything else you could share about this? Congrats. How does it feel? Tell us what it's like raising $500 million.
I can't talk about that, but what I can talk about is Dankrad is probably one of the few people on earth like LeBron or Madonna that get their own first name and everybody knows what it means. Genuinely excited to have a world-class talent who's been there and contributed more than anybody. One of the other things you might not have seen in the news as well is that Tempo also acquired Ithaca, which Georgios has been leading for many years, one of the premier contributors to the Ethereum ecosystem, builders of the Porto client, builders of Reth, really pushing the performance, speed, and scalability of the EVM ecosystem. So how do I feel? I feel massively out of my depth, Cuy. I am surrounded by people far better at me who know what they're talking about. Thankfully, I'm hanging on to this British accent and trying to explain things to people slowly in the hope that they still think I'm smart. I'm going to have to buy different glasses. But no, genuinely overwhelmed by this talent and really enjoying building a chain and thinking about the trade-offs and trying to make it payments native and solve real problems. We've got product market fit. We've got an unlimited opportunity. I think the time's now to really do something special. And why not? The pressure's on them. We've assembled possibly the best team, but we really need to deliver on that. And we feel that responsibility. I certainly do.
You know what? It's a personal opinion. Let me just interject and say that the thing that I don't like about this is that before all of this Tempo thing, it was pretty easy to identify the Death Star of crypto, which was absolutely Coinbase. And now there's competition for the Death Star, and I am not sure if I'm happy about this or not. So I don't know which one is the Death Star anymore.
Well, we don't have a main net yet, so let's try ship something first before it could be anything, you know?
Yeah, say more. Diogo, payments chains are a thing. There are people on both sides. How do you approach from the investment hat? What is the opportunity here? Why is everyone so excited about payment chains in the first place?
Look, I think I know what the hypothetical, theoretical framework, but the answer is we don't know. We don't know what the market structure is going to be. These things are new. What we know is very great companies with great brands and great engineering teams are putting serious money behind new vertically integrated blockchains in some cases that actually have as a single purpose, in some cases, say stablecoin payments, stablecoin FX, or just generalized versions of those areas. Some of them don't even have smart contracts, which is kind of surprising. Some of these, specific blockchains that are coming out for L1s for stables don't even have smart contracts under the idea that they can be much faster and they don't have to be generalizable because they're single purpose. But what we're seeing now in my mind is, I think one of the things that is less talked about is whole ecosystems. And so somebody like Stripe, somebody like these companies can create their own ecosystems based on the blockchain where they can actually provide services, Oracle services, API services, payment services, and then developers can just come and build in their ecosystem. Before, an ecosystem was a set of APIs, maybe dozens, and a page, documentation page that showed you how to use them. Maybe now the new actual ecosystems are just smart contract languages running on these blockchains by these ecosystems, and that have these sync points into the businesses of the participants that allow them to make money from it. I think that's my best explanation of what's actually coming next, and why this actually really makes sense over the long term.
And Michelle, you've been following stablecoins for a long time. How do you think about the evolution of stablecoins going multi-chain, using existing chains? Now you've got general purpose blockchains that where all the stablecoin supply is, trying to figure out how they can compete with a next generation of payments chains that are coming online. What is this battle going to look like? And is there the other side of it to say, you know what, it's actually the general purpose. It's going to be Ethereum, it's going to be Solana that are going to be the chains where a lot of the activity continues to grow?
I think if we look the trends in the industry over, let's say, the last decade, where we are with getting to real world use and solving the problems of what the crypto industry has been wanting to do since its onset, the promise of stablecoins has long been stuck, I believe, within industries that weren't using it at scale or weren't really realizing the purpose. They were jumping on stablecoin summer last year because everyone was talking about it. This now brings forward simplification, making it easier and accessible for people who don't have huge teams, don't have big dev teams. They can get in, plug in, go and run. So that's what I think is most excited about it. We'll see probably in the next 12 months feels like a lifetime from now. In the next 12 months, the conversation will likely be who is winning this. And I'm not going to make a prediction because I don't want to see on X someone calling out this prediction then telling me I'm wrong. So I'm going to reserve that. But what's exciting is really the ability for wider adoption and testing and experimentation.
I think if I was just to add some color to this, why I got excited about Tempo originally, there's definitely a lot of lessons learned, I think, from reps and cycles in every part of the industry we've had over the past decade. And I think one of the big lessons is 99% of people don't use stablecoins every day. And for those people that don't use it, a lot of that is about building up to their problem and doing product stuff. We can have the highest ideals, but we've also got to solve a problem. And some of the things that the traditional payments industry does really, really well are not done well in crypto. Things like reliability. Things like when I make a payment, it's going to go through and it's going to go through fairly consistently. Surprisingly hard to do in most chains. If they get congested, like we saw a couple of weekends ago with the big depegging that wasn't depegging of Athena and the auto deleveraging, suddenly fees are spiking. Suddenly we've got network congestion. What if you make payments a first-class citizen? Because that would be what everybody else would expect. You can't have payroll not happen. You can't have critical market structures go down if you're going to bring in the 99%. But if you can have a world in which you start from the payments and you build up, then you can start to layer on other products over time and you can get more complex, but start simple and build there and build for the 99%. I don't think that that's wrong, but I don't think that that obviates the need for other things to go away either. We tend to paint this as a binary, like, it's going to be all this chain or that chain and this religion and that religion. I suspect there will be many chains, but there's a frontier. We've not finished the evolution of what on-chain finance is. And on-chain payments really do need to evolve to solve for the 99%. And it's really exciting to be working with some basic quality of life features for payments nerds, like having support for memo fields, like having an enshrined AMM, like having native account abstraction at the chain level, so you don't have to write a separate smart contract if you want to get rid of these gas fees for users. The amount of things we've had to build on top of Ethereum and other chains because they were built a certain way is quite dramatic. What if the chain just took care of that for you? And I think you can only learn that by standing on the shoulders of people who've built other things that have been successful. So I don't think it's an either or. I think it's a learn from everybody and try and solve a problem for somebody.
No, the only thing that I would say, Kai, it's not quite as pushback. Maybe I'll frame it as pushback. So this is interesting and there's like some active debate. But the main thing is that if you take away requirements, things are just much easier. Of course, if you take decentralization as a requirement, things are faster. Of course, you can get to higher, lower latency and higher availability. And like every engineer knows, if you take requirements, it's like it becomes much easier to build these systems. And I think the best, most honest description of what this is at its core is the form factor of smart contracts on these ledgers that have these kinds of ability for developers to interact with permissionlessly are a fantastic form factor that is winning out on the internet for entrepreneurs building their companies. And this is the companies adapting to that form factor. So we're basically like moving away from just APIs and REST APIs to no, smart contracts running on this. I think that is actually a fairer version, but there are still corporate APIs generally. I think they're going to be much more powerful because they're going to likely, we don't know, again, it's not mainnet, but in many of these cases, they're going to likely be permissionless and people will be able to run arbitrary smart contracts and compose them in arguably much easier to integrate with two different blockchains, a permissionless one that is public and a semi-permissioned one that is private, than with just an API and a database on the background. So I think it is a positive movement.
Just for clarity, the intent of Tempo is to be decentralized, permissionless over time, starting with a closed validator set, right? So, and we've seen other chains go that route before. It's also fully open to every single competitor in the Stripe stack. So, other bridge competitors, other privy competitors, other payments companies could all use this platform, but this platform doesn't exist at the scale that could handle the volume of a payments business along that, that's moving trillions on an annual basis. So really the design target is not how do you just take away requirements, it's how do you solve requirements that are not yet solved. So it's just
okay, that's fair. But the main requirement that you're taking away that the crypto community started out with Bitcoin was sovereign resistance. And sovereign resistance just leads you to a totally different set of solutions than the ones that we're in. So it sort of feels like we started with sovereign resistance and we're sort of like chipping away at like the requirements. You see that with Hyperliquid. You see that with Solana. You see that with all of these chains where you can like chip away at it and you sort of like create a spectrum. And I love this. I love that there's a spectrum for us to engage with. And I love that if I want to go very fast throughput, high availability, amazing engineering teams, I can go to something like Tempo, which, is more corporate. There's going to be more SLAs, that type of like behavior. And if I want something on the fully centralized spectrum, I can go towards something more like Ethereum. And so I like this. I think this is great for the ecosystem.
Cuy, have you been getting lots of questions?
We get lots of questions about everything. I think part of the debate that's been interesting to see is it's almost like you had like very general purpose L1s, and then you have this thesis of app chains that may likely be L2s, and you had the Ethereum ecosystem, you had the OP stack, you had Arbitrum, you had the success of Base, and then now when you have these payments chains, pretty much every payments chain, at least most of them are L1s, and so you kind of have this tension of how do you think about the value and the trade-offs of bootstrapping a new L1 versus building an L2 or a layer on top of an existing chain. So Michelle, do you have a take on that? That has gotten people really riled up on Twitter of why isn't this an L2? I demand you tell me why this isn't an L2. Are people overreacting? How do you think about that, the different design decisions between them?
I always step back and look at what are we trying to solve for. And if we look at what we're trying to solve for, getting out of our own way, I think would serve a lot of us oftentimes to remember when we get on a hill and people get really upset about it. At the end of the day, while their opinion is valid and should be respected, why does it matter? Is it a moral stance of why they need to do it? Is it, I believe in this, or is it to solve a problem, or is it to build on top or increase community presence, perception, etc.? If you get all of the kind of noise nonsense out of it, why does it matter? It should be to matter to improve, to get to the 99%, to keep this industry around, to keep building back better, and stop we get in our own way so much, and we've get in Twitter spats that are sometimes so interesting, and if you watch it, you just go, why are we down here in the weeds? And someone outside of the industry watching goes, what the hell are they even talking about? And someone get me a thesaurus so I can follow this thread.
Can I just say that I think actually is 80%, the majority of the thing of L1s, and I want to fight with Simon on this, but it's 80% NIH syndrome, not invented here syndrome. It's 80% it, where it was not invented here, and thus I don't want to use it because I'm an engineer and I can actually build it myself. So I'm just going to continue iterating. And there's cool technology that comes out. And so not invented here syndrome, I think, accounts for 80% of it. And I think the 20% of it is, the things that Simon is saying, which is, no, there's these memos and these utility fields, but by the way, exist in many blockchains, viewing keys, privacy keys, you're getting arbitrary data can be written in any block. And so you can sort of interpret it at the application level, whatever you want into this thing. And you can have authenticated messages. There's so many ways for you to do this. So I think it's 20% that, which I recognize, but 80% not invented here syndrome.
I like NIH. I haven't heard that before.
Oh, it's a classic. It exists inside every organization to some extent. But I would point you to the history of sort of Liam and Georgios. They're helping build Base. Liam, the architect of the OP stack. This is people who've tried L2s and sort of found them wanting in terms of performance and found them wanting in terms of what you can bake into the chain itself. And I just think there's a genuine attempt to make something that is fast enough to be internet scale infrastructure. And there isn't yet something that could be internet scale infrastructure. And by tapping into different distribution partners, maybe you could test that. It's also very much the case, you're absolutely right, Diogo, that a lot of that memo fields and referencing, and it does exist in Solana, it exists elsewhere, nobody kind of uses it. But if you enshrine it and you make it a part of how you do every single payment, you make the default different. And I think making the default different is powerful, and you sort of almost have to go somewhere else and start with a different customer segment to make the default different. That's kind of something between the lines.
But I agree with all that. Let me just point out that is what someone suffering from NIH syndrome would say, by the way. That is typically they come into a new company, it needs to be faster, that nothing exists right now at scale, and thus we need to build something completely new. Right. So let me just say that is, if we're in the doctor right now, Simon, I would prescribe you with, maybe you are suffering from some NIH.
Yeah, potentially. But then, you go speak to a bunch of folks and you listen to them and you say, what problems are you having? Like, why haven't you gone on chain yet? And they'll tell you the same things. And you then go speak to the lawyers inside their organization and they'll tell you the same things. And then you go speak to the engineers and they'll say, this is really annoying us and we're getting stuck on this all the time. And if you were going to make really great, like developer tooling and great docs and great everything else, I think that's what, if you look back at, I'm a payments nerd, what Stripe did really well was allow anybody to accept payments with 7 lines of code. That, being able to accept payments on the internet existed long before Stripe. Making it so easy that almost anybody could do it in 7 lines of code, that's incredibly difficult. You can tell a lot of effort went into making that look effortless. And that is, sometimes there's almost no rational reason. It's thousands of tiny little decisions that add up to one great experience. And that product mindset, I think, has sort of been missing from the conversation. All right.
I think that's fair.
Going to move us to the next story because it seems to be we've gone from stablecoin summer to acquisition fall. Classic example over here is Ripple acquiring a company called G Treasury for $1 billion. This is a treasury management system provider, and it's the third major acquisition for Ripple in 2025. Their clients include major corporations such as American Airlines, Goodyear, Volvo, and they process $12.5 trillion in payments volume. I think to date, maybe not annually, it wasn't really clear. There was a very vague figure that they threw out. Michelle, corporate treasury, not something that we've historically thought with on-chain finance, but seems to be gaining momentum. Why this for Ripple? Why corporate treasury for stablecoins? What are your thoughts there?
So a little history that will go and then I'll get to it. So I started at BitReserve in 2014. And the founder, Halsey Minor, his vision was corporate treasury because he couldn't be banked because he was a billionaire who'd had a few blips and bankruptcies. So literally people wouldn't bank him. And his vision in creating BitReserve, well, I'm just going to make something for myself that can address this and build corporate treasuries. They're going to tokenize XYZ. So fast forward a decade plus later, it's really interesting to see this run of acquisitions that Ripple has had. We saw the headline when they were looking at Circle, et cetera. The corporate treasury, to me, it makes such sense that I'm surprised it's taken so long, but that's often how it is. It's that aha moment, or yes, they're ready, and then it's time, or you need the first one to make the jump and then the rest follow. What was surprising with this was the size. To your point, the volume and time in which they were saying the volume, I kind of wanted to go deeper and see what that meant, because it's understanding then how much Ripple's growing and where they're growing and what that looks like with this acquisition. So overall, I think it's the first of many, and it's sort of the next to bring on chain at scale. So they've got a few more months. Let's see who else they get in by end of year.
Yeah, it seems like they're really executing on an M&A playbook and acquiring some assets that are pretty unique from a distribution standpoint. And so it started with the Hidden Road acquisition over $1 billion a few months ago, and then now G Treasury. And I think that the question that I have with Ripple's a really interesting business that has like multiple pieces. It seems clear that with Hidden Road and now G Treasury, there's an opportunity to integrate their stablecoin Ripple USD or RLUSD. And if you own the interface, you own the distribution, you're orchestrating payments, or the prime brokerage business that they have, being able to embed RLUSD as the default in interesting ways, like that seems like something that's a pretty clear path for them to execute. Then my question is, well, is it going to be RLUSD running on XRPL? Or is it going to be RLUSD running on existing chains? Last time I checked, the majority of RLUSD supply is actually running on Ethereum. And it seems like RLUSD is this like multi-chain stablecoin. It's not necessarily XRPL. And so how much is XRPL going to be a part of it? Is that going to get adoption? And then the last piece is XRP of, okay, well, if you're not using XRPL, are you using XRP? Are you going to try and embed XRP as a bridge currency, which seemed like that was the strategy, many years ago, but then, now it's like, stable coins have played that role as the bridge currency. And so I could absolutely see scenarios that they're able to successfully scale RLUSD. It seems to be growing, pretty quickly today. And like with these assets, could see them integrating it in. But what's not clear yet is how RLUSD translates to XRPL, translates to XRP. And then it seems like the engine that's funding a lot of this growth and acquisition is ultimately XRP with the value expected of coming back from RLUSD. And so you have this like really interesting flywheel that is playing out for them, but not necessarily clear how the pieces are connecting from a fundamental practical standpoint. And so like respect to they're executing on the M&A path, and I could see paths here, but Diogo, how do you think about that? RLUSD, XRPL, XRP, like how should we reconcile those together?
You come to me because I have the spicy takes. I think my take is that they don't even know it themselves. That's what's happening. And it is primarily a currency or cryptocurrency that has gained mind share, and it's a marketing engine that is now being turned through M&A into an actual business. I think that's the best description for it. And I think the hypothesis, by the way, on the treasury management and on the acquisition of these companies is if you have the customer relationship, if you have the flow, if you have the assets under custody, management, administration, then you'll be able to actually, influence which stablecoin is appointing. So to a certain extent, it could actually be the go-to-market motion that you're in, like you get enough volume, get enough business, and then you can actually have a seat at the table to decide which currency goes in. I actually really appreciate what they've been doing for the space. In particular, I think it's worth pointing out that before 2025, I believe there was exactly zero over $1 billion M&A crypto, zero. And then in 2025 alone, we've already had 4, maybe 5 acquisitions over $1 billion. And this has just turned candidly the conversation in VC land from tokens are the thing that matters in crypto to, turns out equity actually has a lot of value and you can have major outcomes here. And obviously like Circle's IPO and the IPOs that have been happening also are the other side of the coin here, also on the equity piece. And so those together have been amazing for our portfolio, for all of our companies. And having an acquirer, there's actually discerning of the business quality and trying to like compose them into something that they're going to use to dominate on their stablecoin, I think is interesting and it helps us all. So I'm not upset about it, but I also don't understand the strategy.
What I think is interesting is how every large bank's biggest customers have been asking them what they're going to be doing with stablecoins. Because from a treasury management standpoint, if I'm Netflix or if I'm Coca-Cola and I have to deal with lots of markets and lots of long-tail currencies, that gets really expensive and really hard. And I might have 35 banks, which means each legal entity might have 10 different banks. So per legal entity, of which maybe I have 100, I have 30 bank accounts per legal entity, each with a different login, and I have to reconcile all of that against my treasury management system or my ERP. And I probably need a staff of a couple of hundred people to do just that, just to know where my money is and move it. People think this is a fees problem. It's mostly a complexity issue. And the idea of being able to do, like one wallet to rule them all per legal entity, where all of the deposits from all of the banks and all of my stablecoins can just sit in a single pane of glass, is like nirvana to most CFOs, if you could get them there. So going on chain helps you with some of that, but there's also then like a bunch of gnarly legal questions of like, wait, so could the balances I have at BNY sit inside a wallet from Citibank? What does that mean? Is that still inside the bank? Is that outside the bank? So I look at this acquisition as being like the on-chain finance world coming into CFOs and treasury management, but you've also got the banks who are being pushed by this the CFOs and their biggest corporate clients to figure out how they're going to start doing some tokenization, because the banks are struggling to some extent to sell their token services to other clients outside of Ant Group and a few technology companies. Because what good is it to have token services that I can only move with one bank when as a global corporate, I have 20, 30 banks? I need this to interoperate. Then the on-chain world interoperates, but it doesn't work with the rest of my universe. So for the next 3 to 5 years, these things are going to start to collide. And I think that's going to be like treasury management is going to become a really crucial point. Cuy, how much are you seeing treasury management in your conversations day to day? And how much do you think that is part of the future piece here? Or are you still more focused on, payouts and other use cases?
Yeah, we've had some really interesting discussions with treasury teams at large merchants. I think that the biggest takeaway is they're all in kind of very much like learning mode. Like they're not ready to do something today, but it's like one of the priorities to really understand the use cases and what it can mean. I've found that privacy has come up multiple times where that has been something that they're like, wait, what? You're telling me that there might be a hedge fund that is able to detect that these wallets are our supplier payments and figure out how much of these goods that we're buying like over time. Like that's insane. Like it's the last thing that I want. And so I think privacy is probably going to be a major area that has to be solved if you're going to see the Coca-Colas of the world like moving billions and billions of dollars on chain. But I think there's clear interest, and I'm fascinated by this idea of like you could separate the interface from the underlying money. And traditionally, those have been the same. That you have a bank login, and you have the bank's money there, and you're dependent upon what features do you want in that interface? How is that going to update? Versus if you have a institutional grade self custodial wallet infrastructure, or it could even be custodial that could then innovate and compete around what is the interface for a corporate treasurer. But like you mentioned, having the forms of money, whether they're tokenized deposits or stablecoins, that sit behind it and can all work within the same interface. I think that makes a lot of sense in principle, but you need privacy. You still have to figure out the tax and the accounting and the connections into the existing treasury systems. You need FX. I think that's the other thing that comes up a lot is like, okay, like I operate in a bunch of currencies. Right now I look at stablecoins and I only see dollars. And so when we have to convert from dollars to other currencies, well, then you have to go back off chain. And what's the liquidity of going USDC to MXN versus going USD to MXN? And so I think we're a ways from getting to the on-chain FX side. So I think it's very clear that Treasury is going to be a use case. I think I will be surprised if there are a lot of things happening in the next 6 to 12 months, but I would be shocked if there's not a lot of things happening in 3 years. And so it's one of those things that we're like right in between that period of adoption.
Some of the challenges that we saw at TaxBit, which I just recently left, managing globally. So let's say you want to use stablecoins. You have different banks, different entities, different legal entities. Different countries, different geographies, different regulatory bodies have different requirements, reporting, tax, etc. So it becomes something that should be very easy, moving instantly across borders to solve time, velocity, scale, save money, have more insight into what you have, becomes really challenging because you have to layer in the reporting requirements, the regulatory requirements, the need for one-to-one based on what the government has. So it's different parts of a puzzle being solved and everyone's saying they want to solve it. But now it's kind of a race of who's doing it first is one of the other challenges that we'll face. So it's not only the how do we make the interoperability challenge, it's how do we then make the regulatory and global synergy of how people work together, because it's a whole other challenge that people are facing.
I think it was the BIS or somebody recently, one of the major regulators, highlighted that the lack of harmonization of regulatory regimes was going to be the major problem. When we founded Global Digital Finance in 2017, I called it Global Digital Finance because the nature of on-chain is natively global, but regulation is not. So we were going to need to harmonize some of this stuff from the very beginning. Like it's really great that the US has one regulatory approach, but China's taking a very different view of stablecoins at the moment, maybe sort of pulling back a little bit after seemingly pushing forward through Hong Kong. Europe has a wildly different setup to the US. Then you see the UAE's out somewhere else. And then you've got the OECD countries that are just kind of looking to try and catch up, worried about dollarization. it's a difficult challenge right now to figure out, like, how do I do this as a global company? But there are these pockets where it sort of makes a lot of sense for, just if I do have dollars stacking up in different parts of the world, being able to collect those is useful. That's not for everybody, not for all the time. But I've talked in the past couple of episodes a few times about Ant Financial. They have their own L2. They've been pushing all of the corporates all of the banks to tokenize. They've been pushing them to do FX. They're starting to issue their own treasury management token outside of Europe itself. That is, like a typical Chinese company, like 3 to 5 years ahead of everybody else, and showing you what corporate treasury will look like in 3 to 5 years, and almost pushing the financial institutions and everybody else to adapt to that, so that when everybody else catches up, the infrastructure's there and robust. And they've also, if you look at Ant Financial's L2, Jove, they've really pushed the boundaries of like privacy tech. They're doing a lot on trusted execution environments. Fascinating company to watch. Well, speaking of regulation, we are actually going to a story soon, but I do want to pause and thank our sponsors before we hear from them. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's tokenized asset platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Bridge, a Stripe company. Just as the internet made information global, stablecoins are making money global. Bridge, a Stripe company, is the infrastructure powering that shift. It's built for speed, scale, and simplicity. Bridge helps businesses send, store, and accept stablecoin payments instantly. You can serve global customers without navigating the complexities of setting up those crypto rails. It's how companies like X, Shopify, and AirTM unlock new markets, reduce their FX costs, and move money at internet speed. Explore the future of global financial infrastructure at bridge.xyz. Thank you to our sponsors. Next story came from, well, just about everywhere, but the governor of the Federal Reserve, Governor Waller, has signaled a kind of a major shift towards what was called a payments account, or a skinny version of a master account, in a really fascinating speech where there are a couple of quotes we picked out here. I wanted to send a message that this is a new era for Federal Reserve in payments. The DeFi industry is not viewed with suspicion or scorn. Distributed ledgers and crypto are increasingly becoming woven into the fabric of payment and financial systems, and he's asked the Fed to explore the idea of a payment account, which he believed could be beneficial for entities focused on innovations in payments. It'd be remiss of me not to come to Diogo first on this, having run the gauntlet of getting Fed Master Account access, going through the OCC and becoming a federally chartered bank. Tell me first, for the uninitiated, why is Fed Master Account access useful, and what's different about this payment account to traditional Fed Master accounts?
I guess now doing it twice, or helping folks do it twice. It's the only insane person that is actually willing to do this twice. The other day, it was so funny, like I had an interview, and the regulator, the main regulator, the first thing that they said when I came into this meeting was like, "Diogo, welcome back." And I don't know exactly how to feel about this right now. If I should be happy about it, or if I should be extremely disappointed with the decisions that I've made in life. Look, I think the most high level view here is Fed Master Account allows you to have access directly to the banking system. The FedWire system allows you to have your own accounts and essentially park money at the Fed. You also, in many cases, have access to the overnight window, and you get to do some fun stuff with accessing directly those rates. So it's just the ultimate expression of being connected to the core banking infrastructure, and everyone would like it because it's a benefit that not that many folks have, and that they have to pay dearly for in terms of compliance and operational cost to maintain it. So that's why everybody would like to have it. And if you think about all fintechs trying to actually like move money around within the United States, they at some point depend on someone that needs direct FatMaster account to move all of the money around. I think it's kind of interesting from a policy perspective. I think, Simon, you remember when the first narrow bank was actually being proposed and it was shot down by the Fed. And the complaints from the traditional banks was that if there was a narrow bank and you had straight liabilities from the Fed, would this mean that everybody would just like take their deposits away from the fractional reserve and just go straight to it? And then somehow crypto created a narrow bank called stablecoins. And here we are. Now we sort of like backdoored into it. Now it's not exactly the same thing, as you guys know, because, there's treasury bills, which, sort of works the same, but there's a portion of it that sits at some GSIB usually. And so that portion of it is still in the traditional fractional banking system, but we've sort of like reverse engineered into it. And now there's really cool other folks in other banks with broker dealers doing settlement with T-bills, and everybody going towards how can we reduce the risk of the system, and how can we actually not have fractional reserve here? How can we actually have full depository banks like Anchorage take account into these things and work within this new system that we've created? I think that's a kind of fascinating conversation. I'm glad they're open to it. I think it removes leverage from the system. It makes the banking system safer in general. I don't think the concerns from traditional banks have actually been, they're going to defend their own business. That's basically all I have to say about it, regardless of what the truth on the ground is. And that seems to be what's happening.
Yeah, this seems like a really big deal. And the first thing I thought about, we recorded a podcast, Simon, you and I, like 3 years ago with George Selgin, who is professor, monetary theorist, who talked about narrow banking. And it's been this like concept that like monetary nerds like have talked about for a long time, in this idea of unbundling credit and lending from payments. Right now, they're one and the same. You put your money in the bank, you get access to payment services, and the bank does lending. But there have been other countries, other times where that hasn't necessarily been the case. Now with fintech, I think that fintech historically in the U.S. has always been built on top of banks. It's always been really an interface that is sitting on top of a bank. And then it's fascinating that other markets in UK, right, that you have fintechs who have direct master accounts with the Bank of England. And so it's not that this is unprecedented. It's almost that the Fed and the banks in the US have been very opposed to this for some period of time. But like Diogo said, stablecoins seem to be accelerating this transition and the creation of new types of things that look like narrow banks. So what I'm really interested to see is, if you fast forward and you imagine in a few years, you might have stablecoin issuers who have Fed accounts. Are they going to end up backing stablecoins directly with central bank reserves? Are they going to be able to operate a stablecoin end to end without even needing a reserve bank and just being able to manage that? And then doesn't that start to look like synthetic CBDC, which is this other concept that the IMF was talking about of like, you don't need the government to create CBDC. You could just give Fed accounts to private sector companies, and you could actually have stablecoins, if you wanted, be backed one-to-one by central bank reserves. And so there's so many interesting products, like Diogo mentioned, that this would open up. And then on the other side, so many potential competitive dynamics and challenges for banks if they now have a whole new class of fintechs and crypto companies who are going to be going as direct to the metal as possible, operating really lower cost payments and financial services that are separating credit from payments. So I think Waller, to his credit, has been really leaning into stablecoins and been on the forefront of this for a while.
Ahead of his time.
Way ahead of his time. And so it's going to be really interesting to see how this plays out. And then what reaction banks have. Are they going to push back on this? Like, how does that play out? Because
that is certainty, and they already have. Yeah. And you've seen it. That is a certainty. It's their business model that is at risk, they claim, right?
Michelle, I'm interested in your perspective on the part of this announcement that said that there would be no yield on kind of the Fed master account reserves, unlike a traditional master account. So as a payments account, it is designed that you would almost not have positive economics in the way that a bank does from the overnight window. Again, designed to sort of separate payments. There's also an interesting interview I saw with Governor Waller recently where he said he was actually sort of supportive of the bank position that stablecoins should not pay yield. So whilst this on the surface is being reported as red meat for the crypto industry, there is this desire, to Cuy's point, to kind of continue to bifurcate payments from the other. How do you think about the economic benefit here? Is this like risk management so I don't get debanked? Is this I've got access to it? What do you think the upside here is if this came to pass?
It seems to me that it's trying to move fast, move ahead of time, and still mitigate some of the debanking issues. Banks are putting a lot against a lot, and there are some really interesting conversations happening in DC and other areas. I envision this will change. I do think it's moving toward where someone somewhere will be able to solve it. There's no reason why they shouldn't be able to offer yield other than trying to keep both sides happy. And here's your first phase. Here's this. Move forward. Congratulations, crypto. You're in the room now. But it's only a matter of time before, if there's a bank acquisition of someone issuing, then suddenly, oh, it's okay now. It would be okay for yield. So it seems that it's trying to keep everyone happy while they continue to move forward.
Diogo, I can't help but look at this as somebody sitting in the UK where we've had this since 2017. And like payments accounts.
There's a lot of that in Europe versus the US. I mean,
but I guess Singapore, Australia, the UAE, like payments accounts are not wild. This is just like the Fed kind of catching up with everybody else. And I again, the fintech nerd in me looks at this and goes, actually, I think the biggest beneficiary is probably going to be somebody like Wise. Like they are somebody whose unit economics materially improve because they operate at such scale that the tiny bits of margin that a bank makes on the gap between them and the Fed master account really make a meaningful difference to somebody like Wise versus this is being made into a stablecoin story, but really it's a payment story, and I think that's a more interesting takeaway.
Yeah, I was just going to say, it also feels that it's dipping your toe in getting much closer to a CBDC and what that means, and it feels like it's the first real move by the administration to welcome digital assets.
Yeah, I really do think it's going to be fascinating. Sort of 3 years, right? Because these things take time. Pretty
across
much
the board.
Yeah, like there are some central banks, like the Swiss central bank, that's already been experimenting with CBDC, where they've already done live tokenized deposits between banks, where you can get access to that. The Bank of International Settlements Hub in the UK, they're looking at wholesale CBDC to be backing some of these transactions. So I suspect this goes a little bit like we've seen where the Bank of England was one of the first to do its kind of access to the master accounts and settlement against the RTGS. I wonder if we could start to see that with stablecoins, tokenized deposits settling across a central bank, and you build that layering out. That's going to be fascinating to watch. What's different today that wasn't true 5-10 years ago is now you have a Fed that wants to go really, really quickly. And what would happen if you had thoughtful central bankers at the Fed and thoughtful central bankers in Switzerland, thoughtful central bankers at the Bank of England? Could you start to do something really interesting there between those layers and build a bit of a model that makes sense? What can I say? I like speculating sometimes. It's a lot of fun. Are there any other takeaways you had from this, or should I cover off the last story we had this week? Because I do want to give it a shout out to one story.
I just, I'm surprised that the CBDC thing is still around. I thought we killed it. Didn't we kill it?
We might have to call it something else. I feel like it needs to glow up. But ultimately, like, there's this whole idea of settlement finality.
How about government-backed stablecoins?
Yeah, there you go. That's kind of what it is ultimately. Like, you can call it whatever you want.
You just can't use the acronym anymore. I think
it was always a bad
definitely in the US.
It was always confusing.
Yeah.
It sounded like a drug. People would say CBDC. Like what is that? Like, it took a while to like get people to believe it. So I think some form of central bank payment innovation around how central bank money moves on new technologies, great. CBDC, like, it's been a tough brand.
Some sort of tokenized reserve, something like that allows you to have that settlement guarantee and singleness of money. Because ultimately, everybody trying to instantly settle stable coins then kicks off a chain of events that ends up in a Fedwire kind of transaction. So,
and by the way, let me just say one thing on this conversation is like the conversation always becomes one or the other, when in fact, I think it would be better for stablecoins if both existed. A better API for the governments for direct Fedwire access, and stablecoins that actually take advantage of it and actually reduce their final step of risk of actually having straight access to the Fed. And so I think actually, like, in that composition, it's better, but we definitely need a better naming system. Like,
so a quick medley story to finish us off, and we can talk about this more a little bit next week. So 3 acquisitions. There was Coinbase acquiring Echo for $375 million, plus they paid $25 million for an up-only NFT to bring back the podcast. Kobe, how did you do that? Teach me. I will do a tokenized podcast NFT. Like, I'll happily do it. That's just wow. Then, so we can talk a little bit about that story, but also Beam Cash was acquired by Modern Treasury. We're going to have the Modern Treasury guys and Beam Cash guys on the show next week, so we'll talk to them a little bit more. Then I also just saw that Dynamic was acquired by Fireblocks. Lots of M&A, lots of different things happening. Very quickly, Kai, your thoughts specifically on Coinbase acquiring Echo. Is there something about this ICO 2.0? Is there a token life cycle coming back here? Have you had a chance to look at this one?
It's hard to keep up. You're like announcing acquisitions I didn't even know happened this week in the past day. Like, it really is acquisition falls. I don't have
It's almost like my job is to pay attention to, like, if it's...
Yeah, I'm reading I'm getting alerts on my phone of, Trump has pardoned CZ, and it's just like this steady stream of news that's happening that is extremely overwhelming. I think it's exciting. Congrats to the Beam team, Dan Modis, are the second Visa Crypto Mafia exit. Really proud of Dan and the team there. So really happy for him. Diogo probably has a better, spicier take on Coinbase Echo or one of these.
No, I mean, again, congrats to CZ. I mean, what else can we say? So on the ICO 2.0, a new mechanism to fundraise that worked so extremely well the first time around with all of its problems. It had massive problems. It was clear that it had to make a comeback at some point in some new version, hopefully a tamer version with much more transparency and much better projects with actual delivery. I do think that going back to visit it, and, with a company that is so great like Coinbase that does things from a regulatory perspective in a very, very good manner and thinks about it deeply, and also has obviously consumer bone, I think it's fantastic, especially alongside the narrative in the meta right now in crypto, which is revenue. All these companies making revenue. I think that combination is actually a very powerful combination.
Wild.
It's wild. It's wild that we're talking about revenue in crypto, right? Imagine 5 years ago, if I came in and I said, no, Kai, you should be judging this project on revenue. And he would just laugh me out of the room. And so that combo, I think, is a really interesting one. So I think it will come back. It worked extremely well the first time around. It was very fast paced. It obviously has the same stablecoin style advantage of its global first. And so it taps into global liquidity in a global market. And again, like with IPOs becoming later and later, it allows people to feel like they're actually owning these things from the ground up and are aligned. So I think there is something there. We don't know in which form it will materialize, but this meta of the revenue plus actual fundraising that is on chain and people owning these projects from early on, I think it's something that we want in crypto. And it's one of our holy grails.
Coinbase said they'll extend it to tokenized securities in real world assets, and they've already got the list and trade and custody sort of back end of the trade life cycle. But that creation of tokens is interesting. Any final thoughts from you on this, Michelle?
I find ICO always triggering whenever it's brought up. Made it through the first one slightly unscathed. What's nice now is it's bringing the best part of the learnings, real projects, ability, partnering with folks that are regulatory first, which also means consumer protection, hopefully. So I'm excited to go into this next one. Whenever you can make something more accessible, it's always more interesting, and giving people the ability to feel like they were early, it is always something that's exciting.
Kobe's side projects include Lido and this, and they've always gone on to do reasonably quite well. So shout out to that guy who got his start in a fintech company as well, little company called Monzo. So really, really appreciate that guy for having a northern accent and being out there and just crushing. Look, thank you so much, everybody, for watching and listening wherever you do. I want to start by, of course, obviously thanking Diogo for being Diogo. Where can people find out more about you, Anchorage, Haun, and all of the chairs you sit on and microphones?
Online, Twitter, you can search me anywhere. There's only one Diogo Monica on Google.
Now I need a soccer chant for there's only one Diogo Monica. That's going through my head. I know that Patrick just cracked up laughing. Michelle, how about you?
Sure. So I am also on Twitter. My handle is at MQ2OCO. I live in a old world called LinkedIn more often than I'd like to be, and then thedigitalfuture.xyz.
LinkedIn is fire, man. I'm not going to lie. You just copy what happened on X a day later and everyone thinks you're smart. Is that in a British accent?
That is true.
Don't be divulging your secrets out there.
That is true.
Simon.
Copy and paste X to LinkedIn. Just make sure anyone talking about stablecoins, please add the S. Like, anytime I see, like, we're really into stablecoin, it's just this telltale sign that you're like, okay,
that their GPT
you're
is
new
trained
here. Like,
about.
that there are more than one like stable coins, but that is
and Onchain does not have a hyphen. That's good. Good point. All right, Cuy, people want to find out more about you and what you're up to.
On X at Cuy Sheffield and visa.com/crypto.
You'll find me at SY Taylor and slowly losing my mind on LinkedIn. And if you haven't already, please subscribe to this podcast so you can deal with these overcaffeinated thoughts on a regular basis. Tell all of your friends to listen to. We appreciate you. We'll catch you next time.